I am joined today by Aahan Menon of Prometheus Macro. He is a quant, and trusted by some of the biggest and most sophisticated hedge funds around the world. Previous times I have interviewed Aahan on monetary matters, he struck a bullish tone, much more bullish on risk and on stocks over bonds. I am getting a sense that maybe now his positioning and his models might be a little bit different. So I want to know why. What's going on? Aahan, welcome to Monetary Matters. What is your current positioning across your various model portfolios for both your institutional hedge fund clients as well as for clients who subscribe to your research on Substack? What is your positioning broadly, and what is indicated by it? Why this tone and risk off?
Well, great to be back on, Jack. Coming out the gate hot there. There's a lot to cover. Maybe let's start with kind of the big picture backdrop coming from our fastest moving programs, which is our Prometheus multi-strategy program. For those who don't follow every move of Prometheus, Prometheus multi-strategy is basically our primary offering to institutional investors that tries to capture the fastest moving alphas we can find. It trades 49 different global markets, trading equities, bonds, and commodities across the globe. What we're seeing in those programs is basically a meaningful shift down in risk. Until very recently, the programs were essentially long what was popularly called the debasement trade, right? So basically, long all assets, close your eyes, everything go up. Much more recently, probably over the last 3 weeks or so, we've started to become a lot more neutral on equity risk. And we're also starting to become a lot more neutral and potentially negative on commodity risk. What's really driving that is basically increasing kind of concern around the pricing that's in US equity markets and the potential frothiness relative to the likely path of the economy. So basically, we've gone from a position of max bullish all assets to something where we're looking for playing for alpha differentials between different assets. So you can think of much more market neutral exposures. So we're playing for cyclicals versus defensives, things like that. We're playing for relative value opportunities in bond markets, and so that's basically the broad synthesis of the changes that have happened.
So across your portfolios, you're getting less bullish on stocks, less bullish on commodities, and that's for your multi-strategy hedge fund clients, also for Substack. And by the way, Monetary Matters listeners can get a 20% discount to Prometheus Macro on Substack until early December. So folks should click the link to learn more about that. Aahan, you mentioned the economy. What are the indicators that are being picked up about the economy that are going risk off?
We're at a really interesting and slightly concerning place with the economy now. I think there are two levels. So there's the underlying economic dynamic, and then there's the pricing of equities relative to that dynamic. So I'm going to try and break those into two sections and talk about each. If I lose my thread, help me, Jack. But basically, what we're seeing today is a really, really big divergence between what's happening with GDP and spending versus what's happening with the underlying labor market. So I think we touched on this a little bit during our last interview, but we think that there is a pretty meaningful drag on the labor market coming from immigration policy today. That drag on the labor market is resulting in meaningfully slower rates of employment growth, which we're starting to see both in the NFP and the broader employment numbers. While that's happening, we also have a really, really strong surge in AI CapEx spending, which we talked about in our last interview, which is flowing through extremely strongly to GDP, alongside a pretty uneven distribution of income, which basically results in the top, let's say, 25% of income households spending, contributing to almost 70% of total consumption spending. Between that concentrated consumption spending and the AI capex, you basically have GDP numbers that are pretty strong and actually accelerating relative to an employment dynamic, which is actually by some measures even turning negative. That type of situation is pretty inconsistent with almost anything we've seen in history. And so the I think when we take a step back and kind of try to assess whether that divergence can continue, it's pretty unlikely because at the end of the day, labor markets are the center of the universe when it comes to macro. And so things tend to mean revert to the trend of the labor market. And so I think that of what's happening in terms of GDP growth today is actually going to mean revert downwards towards the underlying employment trend. As a result, you probably have lower GDP growth, right? And so that's the underlying divergence, and there's a lot of nuance about like the what's actually driving that labor market weakness, and we can talk about that later. But that's basically the economic divergence.
On why do you think it can't continue? So the economy XAI, formerly known as the economy, is not very strong at all. But this money being pumped into AI and particular data center capital expenditure on semiconductors, data centers, everything is so big that the GDP number is looking very strong. Third quarter real GDP from Atlanta Fed over 4%. I mean, these are just crazy numbers. Why can't that continue? What's going to prevent us from in 2026? I'm talking to you and it's saying, oh my God, spending from the middle class is down year over year, and yet Nvidia, people just spent $300 billion on Nvidia, and nominal GDP is still looking super strong. Like, what's preventing that? Why can't this go on? Not forever, but at least for the near future.
I think it boils down to the circularity. So, does the economy is a circular flow, right? Like economics 101, you learn that the economy is a circular flow. And what that basically just means is that for all of this AI capex, you eventually have to have some amount of consumer spending down the line. And so if you actually start to have a meaningfully slower or perhaps even contractionary consumer spending outlook, what you basically have is you have an economic tanker ship starting to sink. And so what that does is when consumer spending broadly begins to come down a lot, consumer incomes also begin to come down a lot. And as a result, it ends up being reflexive. So most recessionary circumstances or downwards growth trajectories tend to be self-reinforcing because labor is the center of everything. And so all transactions, both on the income side and the spending side, happen through labor. And I think the simple intuition, maybe to put this in a more straightforward way, the capex at some point has to turn into consumption. But if people aren't employed and they don't have wages coming in, you're not going to be able to transition from investment into consumption. And that's the concern when the more medium term kind of concern when it comes to capex, where the only way right now we can continue on this really, really strong pace of economic growth is if AI capex just continues at the current pace, right? It just continues and potentially accelerates. Now, I'm not an AI capex expert in that way, so maybe we could have an extension of it by a quarter or maybe 2 quarters or something like that. But the idea that AI capex can become the whole economy and continue to fuel the whole economy doesn't make sense because that AI capex needs to be financed by something, right? So initially, AI capex has been basically funded by excess cash on balance sheets, but now it's begun to transition into debt. And so as we start to move forward, there are going to be very real constraints on whether AI capex can continue at its current pace. And so if it doesn't actually transition into consumer spending, so recomposing from investment into consumption, you're just going to have a tough time sustaining this kind of growth.
And is that Ahan the human analyst going by that reasoning, or is your model picking up on a certain lack of sustainability in the growth of this very concentrated AI sector?
So a little bit of both, right? What the way we try to look at things is we try to come up with estimates for what the real economy can provide in terms of earnings and then compare those estimates to what current earnings expectations growth is showing, right? And today what we see at the S&P 500 level is not like a huge like mispricing of earnings expectations, but we have begun to see that earnings expectations are probably a little bit rich to what the economy can actually deliver. And so it's coming from our models, but the long form content is my translation of the models. You have this divergence between spending and labor. That's something that's probably unsustainable over a long period of time. And on the flip side, you basically also have equity markets which are really now starting to price really, really lopsided but strong earnings expectations growth. And so that's resulting in a little bit of mispricing. And we think that that's something to be much more cautious about. And you can see that kind of in the fact that almost all of earnings growth today is concentrated in tech and tech adjacent companies, right? And if you look at things that are more classically oriented towards what used to be the economy, things like industrials, real estate, even financials to a certain extent, their earnings growth is much more tepid, right? And so when we look at those kind of those divergences, we think that, hey, like, you're getting to a point where the pricing is a little bit extreme and favors only this sector, and it's all being driven by this AI capex number. So it's a time to probably be a lot more cautious on equities.
And to what degree is your analysis of all of the data capturing a slowdown? And to what degree does that support bond markets? Which I should note, you've been bearish on bond markets since we first did our first interview, probably in 2023, and now it seems you're a little more constructive on them.
Yeah, I mean, bond markets. So I think I've been on a few times to tell you how bonds are the worst. Bonds are the worst is a catchphrase I have now retired. They're not the worst, but at the same time, the challenge in bond markets continues to be the fact that, like, bond markets at every single interval seem to price in expectations of interest rate cuts, and really, really significant ones. And for you to generate a lot of bond alpha on the long side, you have to exceed those interest rate cut expectations in the realized path. So if you're currently pricing 3 interest rate cuts or 4 interest rate cuts, for you to make bond alpha, you have to move from 3 interest rate cuts being priced at like 8. That's a lot of bond alpha. We don't see today as an environment where, we're going to get that type of outcome. That type of outcome is going to happen if we go into a recessionary circumstance. So I think bonds are not something that you necessarily want to short now, but they're also not necessarily something you want to get levered long. They're much more likely to be much more range bound. And so what it really boils down to is not that there's a different outlook for bonds than there is for stocks. They're just priced differently, right? So bonds have a much more moderate kind of growth outcome priced into them. But equities, because of the way that the index composition is made, have a much more exuberant kind of growth expectation built into them. And so as a result, like, I wouldn't go out and short bonds, but at the same time, you might want to start to consider having a small allocation. That's a little bit more of a toss up.
You note in your research that the business cycle is still expanding. Tell
Mhm.
us about that and how that accords with so far the analysis you shared so far.
Look, at the end of the day, the business cycle is really about aggregate corporate profitability, right? And when we look at the aggregate corporate profitability, when we're looking at aggregates, we have to discard all these kind of distributional issues of, oh, it's only in tech, oh, it's only in these few sectors or whatever. A business cycle is really, really defined by what's happening with corporate profits. Corporate profits is one of the best indicators to kind of understand what's happening in the business cycle. And then based on what's happening with corporate profits, you tend to have spillovers in other directions, right? And so the business cycle is expanding because at the end of the day, the majority of companies that make up a very large part of the economy today are still expanding. They have a lot of investment. We still have consumption going. So we are in an expansion, but it's becoming a lopsided expansion to the extent where it's starting to become a little too extreme in its lopsided nature. Now, how does that lopsided nature figure itself out? Does it figure itself out by, AI capex slowing down a little bit and consumption maybe moderating a little bit? And then, okay, we're back to a more normal kind of economic dynamic? That's possible. Does it happen from consumption, falling off a cliff and then AI capex being dragged down? That's also a possibility. But I think the main thing that we're kind of trying to capture is that, yes, we are in a business cycle expansion, but it's increasingly one that's lopsided, and that creates risks to its continuity.
So far, Ahan, and on this, on financial programs, and on other of my interviews, kind of what's implied. There's often an assumption that if you can predict the business cycle, you're going to make money in markets. That if you know there's an economy, there's going to be a recession, you should go underweight stocks, maybe short stocks, and be overweight bonds, buy calls on long dated treasury bonds. You've done work showing that this actually isn't true, and very surprising to me. But what did you find, and why is it the case that if I know that there's going to be a recession in 2026, I think I could make money right now. Why couldn't I? On
There's a lot to that. I think that it's intuitively we like the idea that, we if we have a long-term economic view, we can translate that economic view into positions, and those positions, if our economic views are right, should pay off. But what we find empirically is that long-term economic views tend to have negligible, if not negative, alpha. And the reason is because you have to manage the path dependency of the asset, right? Like, you might get to your long-term forecast. So let's say that the S&P 500, you have a forecast of 8,000, right, over the next year. You might get to that forecast, but for you to make it to that forecast, you have to weather everything the S&P 500 gives you from now until then. And so you could potentially go through an 80% drawdown and then have a 200% rise, or you could have a situation where the S&P moves up in a slow, stable kind of fashion. There's a whole range of expected outcomes, and the the value of professional money management is really in being able to manage the path to getting to your forecast. Your forecast itself is not a very high edge thing. And so, I think we've shared some slides with you guys, kind of breaking down how even if you knew the price of the asset you're trading 1 year forward, you wouldn't be able to generate much better risk adjusted returns than just holding the asset. So there's a reason that professional money managers come to work every single day rather than just making forecasts once a year and then holding those forecasts for the rest of the year. It's because taking an asset for given expected return and reducing its risk is something that requires a lot of skill and requires a lot of adjustment on a very regular basis. Just forecasting stuff doesn't yield much alpha.
So this is a chart you have showing that even with a perfect long-term directional view on the S&P 500, you would not beat the benchmark. So just explain, how is this possible that if I know that the S&P is going to be a certain price a year from now, how is it possible that I wouldn't outperform?
Because the thing is, most investors, whether you're rebalancing, say, let's say, whether you're trading every single day, every single week, or every single month, you have to make it through the next day, next week, and next month to get to your forecast. So you might be right that from over the next year that the price is higher. But the thing is that you still the thing that you're most directly trading is what's right in front of you. And if you don't get that right, you're going to lose money. So I could be right that the S&P 500 is going to be high over the next year. But if I don't get what's going to happen over the next month, right, I'm still going to lose money over the next month. And so it's about managing the path to getting to your forecast. It's not about just having a forecast, right? I think it's a very kind of non-intuitive kind of thing to think about, that if I knew the price a year forward, I think the easiest way to capture it is just that there is no way for you to just trade 1 year chunks of the S&P 500. And so as a result, yeah, you might get that right, but that's not how markets work. That's not how your P&L performance is going to work. So unless you say that every year in Jan 1, I make a forecast of where we're going to be by next year, and then I close my eyes and I don't do anything, you're unlikely to basically have any good results doing that type of approach.
And that's because the price action happens in the short term. And this year is an example that, if you started off this year with a bullish outlook, which we now know is correct because the S&P is higher, as of Q4, that would have had you be one way, but the positioning on Liberation Day could have screwed you, especially if you were running leverage positions because you had down 5%, down 4 or 5% days there. That's what you're saying.
Exactly. So that's a perfect example, right? The end result at the end of this year is stocks up bigly, right? Now let's say that I'm a long-term forecaster and I forecasted that stocks are going to be up a lot. And I said, I have such high confidence, I'm going to 2x level my position. By Liberation Day, you could have been down, depending on how you express the trade, close to 40%. Now the question is, at that point, what is the most likely decision that you make? You will actually end up cutting your you'll end up cutting, because most people don't actually want to go through a 40% drawdown. And so I think what's super important to recognize is what a professional money manager would have done is he would have done the forecasting thing. Okay, put pretty low weight on his 1 year forecast anyway. Like I have the good fortune to work with some really sophisticated investors. They all have long term outlooks and stuff, but they put such little weight on that long term outlook. You would be astonished. But what a professional money manager would have done is he would have had that forecast and said, "Hey, vol is picking up locally. I don't think that I'm on the right side of this trade. So what you would have done is you would have reduced your position as you went into this event, and what you would have done is you would have realized a much lower drawdown, if at all, relative to the S&P 500. And that's where alpha lives. Alpha lives in being able to adjust your positions relative to your expected path. It doesn't live in just making a call and then putting it on and then closing your eyes and waiting for it all to work out.
And I guess that's because buy and hold works, but it's because of the hold. If you're trading, the outcome of your trading is going to be predicted by the the interval in between the time that you close that position,
Yeah,
which is going to be a
absolutely.
short-term view if you're trading.
Absolutely. So there's a really important nuance in how those visuals are calculated too. What we do is we exclude the 1 day forward forecast. So what we say is, hey, like I can't give you this edge. I can't let you say that you can perfectly predict tomorrow. But what I'm going to do is I'm going to say, hey, like you can predict from tomorrow until next year perfectly. Like you are the perfect predictor. You can predict that 100% on point. And it's astonishing to see that if you just shift that window back by 1 day, the P&L curves improve dramatically. And what is that? All that's telling you is that the most important thing that you need to be able to predict is the 1 day forward return. If you can find somebody that does that, please let me know. But that's what most professional shops are trying to do. You're trying to figure out a 1 week, 1 day, in cases of very, very large money, 1 month. Because they have such large transaction costs and it's really hard to move the ship. They're trying to predict 1 month at a maximum. No professional, very serious professional investor, that at least macro investors, and let's say investors that are aiming for one shop ratio and up, right? No investor that's aiming for one shop ratio and up is trying to predict things over the next 6 months or 12 months or a year, not in any definable investable way.
Okay, and then why does prediction of GDP not lead to that? You note that buy and hold the S&P has a Sharpe ratio of 0.54 going back to the 1980s. If you can perfectly predict real GDP, it has a slightly higher Sharpe, 0.67, but almost all of that was in 2008. So other than 2008, you're saying predicting the economy 1 year hence does not improve your returns. Why is that the case?
I think it boils down to the fact that the pricing, right? What you really need to predict is not what happens to the economy. What you need to predict is the changes in pricing of the asset, right? Like so all assets have a certain amount of growth expectation priced into them. That doesn't necessarily respond to the level of realized GDP, right? The 2008 was a unique circumstance in that, there was very little expectations of just such a precipitous fall in economic activity, at least priced into asset markets. And so as a result, you basically had a situation where realized GDP fell, nobody was expecting it, boom, if you were calling that, you just absolutely crushed it. When it comes to, any other period, you basically, economic growth is generally up, which means that you're generally long assets. Recessions are few and far between. And the thing is that, like we were talking about, predicting the 1 year forward return, right? Or, having a view for 1 year forward, it doesn't account for the path to get there. So let's say that I have a recession view, and that recession view is that 1 year from now, we're going to have a recession. Shorting equities from now until that recession period is not necessarily a good idea. It's probably not going to be good for your health. The time when that bet is going to pay off is when markets begin to realize that there's a recession and begin to price that very quickly. And so being able to time those views is really what matters a lot. So just looking at the direction of GDP and trying to say I'm going to go long assets or short assets based on the direction of GDP, it's maybe something that you would think makes sense and is, I would say that that's like kind of like an entry level idea almost. But when you actually get into markets and start trying to actually apply those concepts, you'll find it just doesn't work very well.
And a perfect example of that was 2000, 2008. Obviously, we did have a huge collapse in asset prices as there was a huge growth shock, but the S&P rallied from January 2007 until the fall of 2007, even though we now know that the recession started in the fall of that year, I think actually December of 2007.
Mhm.
So, Ahan, you say that predicting a lot of long-term predictions are not that valuable, and that, GDP nowcast is kind of entry level. Talk about some things that maybe some people would think that they're predictive of long-term returns, but they're actually not, as you've been saying, and in particular why a lot of the stuff that is interesting but does not add a lot of value in terms of increasing Sharpe ratio, you've actually made free on the Prometheus Substack. So for the model portfolios that actually outperform on a risk adjusted basis, that yeah, you charge for, of course, but that you've actually made free what a lot of people consider is very valuable.
So this is something I actually really believe in, to to such an extent that we've basically started a campaign at Prometheus. The slogan of that campaign is pay for portfolios, not for content. The content is in air quotes, right? And the idea there is basically that most, not all, most long-term strategy and forecasting is entirely useless for making portfolio decisions, right? It's not net positive for the end investor using those things unless that end investor has a significant amount of skill. So if somebody is just giving you long-term indications of what their big macro view is, we don't think that that has tangible economic value for a portfolio. And so we just don't think that's something you should pay for. I don't think if you're an investor, 90% of people that are buying economic research aren't doing it because it's just super interesting and they want to stay on top of every economic trend. It's because they're trying to add some value to their portfolio. And so I think as an investor, you shouldn't pay for something that doesn't have tangible economic value, right? And so what we're doing at Prometheus is we're basically making all of those big picture kind of thematic macro research pieces entirely free. All our fundamental economic research on what's happening to growth, what's happening to inflation, is liquidity okay? All of that stuff, which I'm sure anyone that's seen our stuff will know it's competitive with anything across the global buy side or sell side, is entirely 100% free now.
And Alhan, so people maybe say, oh, well, of course, forecasting whether there's going to be a recession doesn't add alpha and Sharpe ratio. It's about the rate of change. And I hear this all the time. Macro is all about the rate of change. You actually show that the buy and hold S&P has a Sharpe ratio of 0.54 again, but that if you have a perfect prediction of the rate of change of real GDP, that has a Sharpe ratio of 0.05%, and your long-term returns going back to 1980 are like 5% or 8%, extremely low compared to the S&P. Why is that the case?
I honestly don't know why people think this rate of change thing is so important, right? Oh, is it It's kind of like become a religion. I personally think it's kind of what is the Dunning Kruger effect? Is that it? Where initially when you start in a field, you think that you really know a lot, and then as you go further, you realize you don't really know that much. I think there's a lot of that when it comes to this rate of change stuff. Like the rate of change of GDP is useful to know, but how that translates into asset prices and its correlation to asset prices is like super suspect. And I struggle to actually find a very meaningful reason as to why I think the last few years are super illustrative, right? What has the S&P 500 done over the last 3 years? It's gone up
Uh,
in a straight line. What has happened to the rate of change of GDP over the last 3 years?
it's gone down. The economy's still been growing quite at a rapid clip, but the rate of growth has gone down.
Exactly, exactly. And so when you look at that, a strategy that basically tries to say, I'm going to imagine if you perfectly predicted the rate of change of GDP and just said, oh, yeah, we're going to hell in a handbasket, right? That would not have worked out well, because what matters is how growth expectations are actually priced into the S&P. What are the starting expectations? And then what is the realized data relative to those expectations? And growth expectations have only gone higher, or the growth expectations have only been beat, and that's what drives the S&P 500, not just some random rate of change metric of GDP growth. And so I'm not really sure what started this whole thing of everything is about the rate of change. But when we look across the evidence, you can do this you can do this for inflation data, you can do it for growth data, you can do it for corporate profit data, you can do it for virtually anything. The rate of change might be useful for a couple of things here and there, but there's no established evidence that the rate of change is like the most important thing for any asset. And all the professional investors that I speak to, they know that the rate of change is important, like in terms of contextualizing what the economic data is doing. But in terms of saying that, oh yeah, like my S&P 500 view is just whether the rate of change of growth is going to accelerate or decelerate, nobody does that.
Think maybe what's implied is that if expectations for growth are what growth is, so if growth is growing at 4% and everyone expects it to be 4%, then growth slowing down to 2% is bearish because that is being priced in. But if the market prices and the market expects growth to go down to 1% and then growth goes down from 4% to 3% instead of going from 4% to 1%, that's bullish.
Yeah, and that's the thing, right? What's priced into markets and beating what's priced into markets is what matters. It's what's the realized economic data trend, and beating that realized economic data trend does not matter.
And that's so true. Ahan, I've lived this like you've lived this, and so many people have lived this of everyone in 2022 being so bearish because the rate of change was going down. It's like, oh,
Mhm.
spending isn't at 12% anymore. It's spending growth is only at 9%. You're telling me the American consumer is their spending growth is only growing by 6% a year? That's a lot. And it doesn't
Mhm.
matter if it's slowing down from 6% from 12%. And again, the
Yeah.
base effects were totally screwed with 2021. I'll just make a case. I know you're saying that predicting the fundamentals doesn't lead to results, but I'll just make a case. Like, Nvidia's revenue growth in 2024 was like 260%. Now
Mhm.
that revenue growth is only 50 or 60%. If someone were to tell me that, next year the revenue growth is only going to be 50% and then in 2027 it's only going to be 45%, like that's still extremely high. And
Yeah.
if someone could forecast that and say, I'm going to sell my Nvidia, I'd say, you're on. I'll buy the Nvidia from you.
Yeah. Yeah.
Still pretty good. 40% revenue growth, still pretty good.
Yeah, and I think what matters is what is analyst consensus at, right?
Yeah.
So I think that's the most important thing. Like, can you get some edge on beating analyst consensus? Sometimes there are reasons why analyst consensus may lag or not, but I think the important takeaway is just these simple reductionistic ideas of, oh, I'm going to predict a recession 1 year out, and I'm going to decide how to do my asset allocation based off that. Oh, I just focus on the base effects and the rate of change of growth, and I'm going to do my asset allocation based off that. Those kind of simple ideas, one, you can test them really easily because they're so simple, and two, like after testing them, you'll find that they just aren't that helpful. Like there's a reason that big macro hedge fund managers take down millions of dollars a year in terms of base compensation, because their skill is in taking that really basic stuff and turning it into actual tradable, investable insights, which they can deploy in their portfolios for their clients. It- I just think that there's so much out there where we have all these basic kind of basic kind of economic concepts that are being parroted as some sort of like truth for markets, and it's often done in a setting where it's taking advantage of investors that aren't necessarily the most sophisticated because they actually have other jobs and other stuff to do, right? It's not like the content itself is super sophisticated. Basic rates of change and like growth and like doing some back tests, like you can get a college grad to be able to do such things, but most people have other things to do. They come to they come to professionals and research providers and stuff expecting these big edges, and a lot of it just isn't isn't what it's touted to be.
And so if GDP nowcasting doesn't work that well, forecasting recessions doesn't work that well, even knowing long-term returns, if you could know them with a crystal ball, even that doesn't work that well from a trading perspective. If that doesn't work, what does work well, Ahan?
So interesting nuance, right? GDP nowcasting, there's a very big difference between GDP nowcasting and GDP forecasting, right? And the difference between GDP nowcasting and GDP forecasting is that GDP nowcasting is basically what's happening today, and maybe, just maybe, where would we be tomorrow. So what you'll tend to find is that as you basically increase the frequency at which you're trying to make predictions or trying to make signals, you'll start to have an increase in accuracy. Now that increase in accuracy is like in percentage points, right? So if you're doing a 1 year forecast and somehow you find something that has like a 50-50 hit rate, going from that 50-50 hit rate and saying that, hey, can I predict like the next print of CPI using State Street's price stats series, and hopefully that isn't priced into consensus, you'll find your edge starts to go up a little bit. And so, what works a lot better than long term forecasting is basically getting a really granular understanding of what's happening right now. Now, the important nuance, right, is that if you can basically say, okay, I want to have a really good understanding of what's happening right now, and find periods where, because of positioning, because of some sort of dislocation, because of some kind of market volatility event, that is what's happening right now in the economy is not properly reflected in markets. Those are your opportunities. That's where most of the alpha tends to live. So, a good example, I'm going to get a lot of hate for this particular example, but Liberation Day, right? I think, you and I talked a lot before Liberation Day, after Liberation Day, and I think I can say that like we had a decently good read of what happened there.
Yeah, you were
Um,
bullish. You were not you had some concerns, but you were not dooming it all, and you said literally we called it economic data still strong.
yeah, yeah. That I mean, that's what we said, and we also said if there's a recession, it's not going to happen tomorrow. We even showed you strategies, right? That if we're in an expansion, which we believe that were an expansion, you could very profitably bet on mean reversion strategies. And so that was a really good case, right? Where we had a view based on all the data that we tracked that even if, tariffs hit their absolute worst, a recession would take a lot of time to kind of come to fruition. But markets had gone ahead and basically priced a recession in like 2 days. And so we saw that as an opportunity. And we met. Unfortunately, we happened to already be long into the opportunity, so it's not like we were net flat and then we managed to get levered long. So we took a drawdown, but we stayed long through that, and that ended up being a good opportunity if you were on you were an alpha investor. And so I think that it's things like that where, for whatever reason, be it because of the way people are positioned, be it because of some data shock, something regulatory, whatever it may be, where markets get shaken up relative to what's happening and what's likely to happen in the very near term, that's really where alpha opportunities are.
And so, Ahan, so Substack providers, they get the three portfolios: the S&P portfolio, the ETF portfolio, and the crisis protection portfolio. But you also give routine uh, um, updates on the multi-strategy portfolio, whether it's, I don't know, twice a month or every other week. But people do get a snapshot of that. And so Ahan, you did write a risk off note to your institutional clients, and Substack people did get a look at that of on November 8th, how your model had significantly de-risked and was shorting home builders and de-risking in stocks as well. What prompted that sell-off or that bearishness on in the middle of November that kind of started this second leg down in the market that began on November 12th?
Yeah, so a lot of what we saw is basically like at the index level, we basically saw the fundamental dynamics that we described previously in this conversation, where, just the earnings are starting to go too far relative to our fair value estimates for earnings. So that's at the index level. And then when we looked across the individual sectors and the global equity indexes, we basically started to see, one, their earnings are beginning to slow, and two, like price trends are beginning to slow as well. And you started to see like a meaningful amount of dispersion between equity indexes. So most of this year, we've actually had some of the largest signals and exposures to global stocks that our programs have ever had. As you know, we backtest everything across decades. We never had this much concentration in long equity exposure ever, even in our backtests.
For the models or for holdings, like for
For the
positioning?
models, which turns into holdings in our multi-strategy program. And so as a result, like our programs were just max long global equities for a really long time for most of this year. But basically what started to happen is you started to see like a lot more dispersion between equity indexes. So they aren't moving all together upwards in the same direction, which basically started to get our strategies a little bit more concerned. You add on top of that our fair value estimates for earnings being a little bit too rich, plus some proprietary mean reversion signals, which started to trigger basically around early November. The combination of those things basically got us from being 100% of our max net long exposure to 40%, then flat, and then short we had the good fortune of actually just getting short right before the meat of the sell off actually hit. And so it's really like that multifaceted process of having coverage across this entire universe, being able to generate independent signals for each one of the assets and aggregate it into one comprehensive view.
And so timing markets is very, very difficult, but you are someone who has models who attempt to do that, and you are very, very good at it. Your clients are, as I said, some of the biggest institutions in the world. There also is a particular asset class that you have been trading, your models have been trading very, very well, that I mentioned, but you told me I'm not allowed to mention it because that was licensed by an institutional portfolio.
Yeah.
So you have very, very legit clients, and they wouldn't be paying you if you didn't provide the value. Just Ahan, just help us understand what are the different models and how they can be useful to investors.
So the Prometheus multi-strategy, which is basically the best of the best of everything that we know about the world, trades 49 different assets across stocks, bonds, and commodities. It basically covers the US equity market and its sectors. It covers global equity indexes. It covers global bond indexes. It has a range of views on from industrial commodities to precious metals. It even has, some long volatility exposures. That is that strategy. It's not one single strategy, it's 10 independent strategies, which are available to institutions and hedge funds that basically come for particular sub strategies. But if we take those strategies and we combine all 10 of them into one aggregated portfolio, you get something that's pretty fucking sick. And that's what the Prometheus multi-strategy program is. It's an aggregation of 10 independent strategies across asset classes, which leads to a huge amount of diversification relative to what most research providers have. Like most research providers in the macro space are basically like, oh yeah, I have a growth inflation view and that drives everything. What we do is we go asset by asset, understand what drives that asset. Like the things that I described in this podcast today are specific understanding of each asset that we trade. There are unique things that drive the term structure of the energy market. There are unique things that drive the mean reversion characteristics of equity markets. There are very unique things that drives the differentials between bond markets. What we do is we systematize those things to create small edges in each one of those markets. And when we aggregate that, we get a comprehensive view of what's happening to the macro economy that changes every single day and allows you to build something that has a lot more signal for a given amount of noise. And so that's really what the Prometheus multi-strategy is. It's adding up unique independent signals in a way that when put together creates a comprehensive view that tends to be a lot more high information value, right? So even our institutional clients that are only focused on a particular set of signals, they want to know what's happening with all other signals because it helps inform them about the broader macro environment with a high degree of overall aggregate signal. A good example is, we have people that work in equity long short space, right? They have nothing to do with commodities, they have nothing to do with bonds in terms of their ability to trade. But what they like to know is what our treasury signals are doing, or what our global bond relative value signals are doing, or what our energy signals are doing, because all of those are inputs into the overall view of what's driving markets. And so, if we can take these independent views and aggregate them up into one comprehensive picture for what's happening in markets, that's probably one of the most high edge things that you can provide someone.
And it's strategy one, strategy two, strategy three. You have many different strategies, many different return streams, and the goal is to combine them all and get something that, as you say, is sick, and very good. That is the strategy. I mean, all the so-called pod shops, very large multi-strategy hedge funds are doing, taking advantage of diversification. So that's in the institutional space, but obviously institutional hedge fund managers listen to this show, but just in terms of numbers, I say, vastly outnumbered by investors who are not, hedge fund managers or portfolio managers and the like. How so? That's how you differentiate yourself within the institutional hedge fund macro space. But how would you say you differentiate your research and your research process and how it can be used and maybe audited and maybe is actionable versus I'll say your competitors who are also uh, uh, sharing their strategies and signals with retail investors, sophisticated retail investors, but individual investors nevertheless.
Yeah, I mean, I think what we offer is totally different from what's typically offered in the space. Like, I mean, Jack, you know me well. I'm not the type of person to really like, speak ill of anyone or anything like that. But I think that when you actually look at what's available in the macro research space, in the semi, kind of quantamental, semi systematic kind of area, what they basically have is a bunch of moving averages dressed up with like a bunch, fancy terms in marketing. That, one, you should not pay for that. Like we could make that completely free if we wanted to. Like if we wanted to design a couple of trend models and trade major asset classes, we could do that entirely for free. What we're trying to do that provides value to retail investors or individual investors, I prefer to say, is we're trying to take. There's a reason we have an institutional business, because there's a lot of people in the industry right now that say, oh yeah, we're democratizing access to institutional tools and institutional research, but you don't work with the institutions. You don't actually know what the best people in the world are doing. What we're trying to do is we're trying to say, hey, like, can we learn from our clients, provide value to them, some of whom are the biggest hedge funds that you've heard of. Like, as you know, Jack, we work with some of the biggest hedge funds in the world. There are legal and compliance reasons you're not allowed to actually mention what those funds are, but most people have heard of those funds. And what we do is we try to provide some value to them. We try to learn from them as well. And we try to come up with the highest alpha systems that we can possibly come up with. And then what we have to try and do is we have to take that and say, how much of this can be replicated in a retail setting? Most high edge alpha is really high turnover, really complex, and it's just requires a lot of trading and a lot of management to really harness all the alpha. What we try to do is we try to say, hey, like, what are the things that an individual could replicate that institutions do? And so that's why you have to have an institutional business, though. You have to have an institutional business to understand what the best people are doing, and then take that and say, hey, like, they are doing market timing across every single equity factor and equity index in the world. Okay, that's probably not something that every individual can do. Can we take some components of beta timing? Like, if we aggregate all their positions and we say, hey, like, how do we think that you can really time beta? Can we apply that in a SPY context? Can we say, hey, like, what are the characteristics that drive treasuries and drive big macro hedge fund P&L in treasuries? Oh, like, if we isolate the 5 or 6 factors, we find that, okay, you might not be able to generate a 1 Sharpe ratio trading treasuries as an individual, but you know what, you might be able to generate a 0.6 Sharpe ratio in equities. You might be able to generate a 0.5 ratio in bonds. They might be uncorrelated. We might be do some smart things around portfolio construction, which can actually cap the amount of drawdowns. And that's really what we're trying to do. We're trying to say, we're going to constantly try to find the best tools and collaborate with the people that are the best in the business. And then we're going to try and say, what are the best tools that we can take and if and effectively and efficiently democratize and make them available to individual investors. That's what we're trying to do as a business. I'm not trying to just come up with some macro views and then say we have our macro views, but we rely on price for execution or something like that. We're doing something totally different. I think that that's really the value that we offer.
Yeah, and I'm not saying that everyone watching this needs to focus on risk-adjusted returns and maximize their Sharpe ratio and spend a lot of time on it at the expense of other things that they have going on in their life, personal commitments, professional commitments, of course. But if people are focused on that, what I'm saying is that Aahan from Prometheus Macro is the guy, and I wouldn't say that if I didn't think it, and I know the space pretty well.
What we're really trying to provide people is, like, we are trying to translate what the best people do in an appropriate way for individuals. Like, we're not like, I think there are lots of people out there that say that, hey, like, you could invest like the best hedge funds in the world. I don't think that's possible. I don't think that's reasonable. And if you try to do that, you'll probably end up much worse off. What we're trying to do is we're trying to say, hey, like, we can get you to a better place. At least we think so. And we're going to try our best to do that for you.
And Ahan, so GDP nowcasting, it's not that it doesn't have a little bit of alpha. I think several years ago over dinner, you said to me, Jack, GDP nowcasting, it has a Sharpe ratio of 0.6. It's fine, but the real alpha comes at finding other things that have a Sharpe ratio of 0.6 or 0.7, and then combining them together, and then levering up those bets and taking advantage of the differentials and the correlations between those different bets.
Yeah, absolutely. So GDP forecasting or GDP nowcasting, like you're saying, it's like fine. It's basically what you would call macro trend following, right? So what you're basically doing is you're saying that economies tend to trend. I want to follow the trend in the economy. And so as a result, like I'm basically going to be in sync with the economic cycle as it unfolds. So the good advantage is as a recession begins to unfold, I'll probably reduce my exposure a little bit. As I begin to get into a recovery, I'll start to increase my exposure a little bit. That type of thing is good, but it's not like world class. The thing that most people are looking for is some sort of perfect GDP prediction, and turning that perfect GDP prediction into perfect asset price predictions. I can tell you, like, I spend all my time trying to do that. That thing doesn't exist. But what does make sense is to say that, okay, I have a GDP prediction or I have a GDP nowcast. I try and follow a GDP nowcast. I want to have an inflation program. I want to have a liquidity program. I want to have something that actually trades the differentials between growth in different countries. And you keep layering on more and more of those different types of signals that you can find. Maybe you have a 1 day signal for a particular economic release. Like, I can tell you a really good example of this that has kind of died, where people didn't realize this like a few years ago, and the CPI moved from being based on the Manheim index to the JD Power index for transportation. So everyone across the sell side was still looking at an index that wasn't relevant to CPI anymore. If you could go get the JD Power index, which they sell, you could actually have a better forecast than what was baked into analyst consensus. So you could run that for a little while, but things like that disappear quite quickly, and it did. So there are small things like this that you can look for, and you keep looking across the global economy, global asset markets for these types of things that are not necessarily in the price, and you add them up, and the aggregate portfolio is something that looks quite attractive. But just trying to do the growth cycle thing, yeah, it's not enough.
And so, on looking at your multi-strategy program, you show the results from 2000 to now are quite extraordinary in terms of Sharpe ratio, Sortino ratio, Kalmar ratio, max drawdown of only 3%, excess returns of 7.3%. It just looks like very close to a straight line up. I will point out, Ahan, that you and I were not adults in the year 2000. So at what point of this multi-strategy is what was it live, and not just taking things and finding something that works, but when did it start being live? And talk about the results, why it's outperformed the S&P on a risk adjusted basis, and why you think it might continue to.
So when it comes to our multi strategy program, we basically went live not for the whole program. We started layering the program in basically live this year. Our results so far this year have been about like 1.6 Sharpe ratio. The main takeaways from the Prometheus multi strategy have basically just been that so far this year we've been pretty risk on. We've had a lot of equity beta, so we've had decently high correlations actually to equity indexes. The big shift that we've actually started to have is we've started to reduce those exposures, and so as a result now we're actually running like negative or minimal equity beta. And so a lot of our performance this year in Prometheus multi strategy has come just from our equity sleeve, which has basically just been like riding the wave of the debasement trade reflected in equities and global equity markets. But when we look across the global equity markets and the US equity market, where we have a lot more insight, we started to see basically those trends start to break down a little bit.
So, Ahan, the multi-strategy is for your institutional clients. For Substack, you've got your S&P portfolio, you've got your ETF portfolio, and then you've got your crisis protection portfolio. So these three model portfolios. Tell us about what each of them do, which are available to your Substack subscribers on Prometheus Macro, and how they differentiate from each other.
So like we've talked about, if you just want to know big what's happening to liquidity, what's happening to growth, is the labor market weak? Don't pay me a cent. You don't have to pay anyone else a cent. So we have all of that for free. You can come get that. In terms of paid content, like I said at the top, I believe when you pay for portfolios, you don't pay for content, right? And so what we have is we have three major portfolios. The first is the Prometheus ETF program, which is I like to joke that it is our full macro program, where we basically, what we're really trying to do over there is we're trying to generate an absolute return. That portfolio is probably going to do well during periods of serious macro volatility, right? So you can think about, it's kind of like it's going to get really active around recessions, big inflations, hiking cycles, that type of thing. Candidly, that portfolio this year, it's a systematic portfolio, has sucked, right? Like I think we've put up about a 6% return this year or something like that, or maybe less. It's just candidly not been a good environment for that. Now, that's your full macro portfolio. The second portfolio that we have is our S&P 500 program. And what that's really designed to do is basically it's meant to outperform in the S&P 500 over a full investment cycle. I think we had a really long form discussion a few months ago about everything that goes into that program. I'm very happy to say that program has done basically, everything that it was intended to. We went through Liberation Day. I think, depending on the implementation style, we had a drawdown between 6 to 8%. As of now, I'm going to jinx this, but we're on track for the completion of a full year, something north of a 10% annualized return. What if that sounds boring to you? It's because it's meant to sound boring. What we're trying to do is we're trying to generate something that's steady, consistent, doesn't have very large drawdowns at a very reasonable amount of volatility. So
And what,
that's
obviously, you're not running a hedge fund, but what roughly is the Sharpe ratio in that?
something north of 0.8.
Okay, okay.
And so that's basically what's happening over there. So the S&P 500, if you care about the S&P 500 a lot, but you're a conservative investor, want to do a little bit of timing, that's probably a good fit for you. Then the last program, which we've launched pretty recently, is I think like one of the most value additive things that we've made, which is basically meant to. It's called the Crisis Protection Program, and it's a bit of a dramatic name, but basically the idea is we wanted to create something that is meant to be negatively correlated to the S&P 500. And so what we did was we went and scoured all the assets, right? Across the globe, and we said, hey, what are the assets that are most mechanically non-correlated to the S&P 500? And what we found is basically that it's a combination of tips, gold, and VIX, right? And we add a certain amount of timing when it comes to these assets, but the objective is basically to give you something that is non-correlated to S&P 500 own holdings, and you could actually implement as an overlay on top of your S&P 500 portfolio. So if you're someone that's just, listen, I want to own the S&P 500 and I wouldn't mind a little bit of outperformance, that strategy is probably something that's interesting for you because you'd be able to stack an additional amount of return and a bit of risk reduction. And so there are multiple different ways to implement that. We have three different implementations of that portfolio. One which does levers the S&P 500 to give you 100% exposure to the S&P plus that portfolio, another which does a bit of a dynamic allocation, and then we also have gone a step further and integrated our S&P 500 program with this crisis protection program. So those are the paid portfolios that are available on Substack. Additionally, every now and again, we send out research that comes from our Prometheus multi-strategy program. So, the objective of that is not to get any individual investor to try to replicate that program. There are very, very serious constraints on individual investors being able to replicate that program. You basically need a whole trading team to be able to run some of those strategies, especially if you're trying to do the whole thing. But the idea of sharing stuff from Prometheus multi-strategy is basically to show and share what our fastest thinking and best edges are telling us about current market conditions. So I think, a very illustrative thing is that our strategies actually did, start to get short before this period of market volatility. And we were able to understand what are the pressures in place, and we were able to flag via written research and also be able to give further context on why our other strategies were actually pulling back on their equity risk. So we provide the multi-strategy program every now and again as kind of added context on top of these three portfolios that we provide.
And what value do these three portfolios provide to investors who don't have a whole team at their macro hedge fund of trading? How can people implement this?
It's always super clear. Every single report is quite literally just dollar allocations of in percentage terms to each one of the assets. So, if you're a discretionary investor with a certain amount of skill, and you're doing your own market timing, you can kind of think of it as like hey, let me check in what Prometheus thinks about, this mix of assets. If you're somebody who just, wants to do a little bit of asset allocation, doesn't have a lot of time, once a week we, each one of these programs, basically depending on your preference and, depending on whether you want to be benchmarked to the S&P, whether you want to do an S&P overlay, whether you want to be a full macro investor, you can come check out those programs and you can say, hey, I'm just going to allocate in line with these programs. So it's really a pick and choose like that.
And yeah, I mean, I think it is a helpful check. I mean, I really do not like technical analysis. I know that there's a lot of it that is legit, but like some people say, "Oh my god, I love this one stock. I want to buy it, but I'm going to wait for the right setup." I don't want to buy it at setups below a moving average or certain demark type stuff. And that's what they do, and they people have success with that. Even though technical analysis isn't really my thing. Okay, so
You
and
want to know
then
something interesting?
yeah,
I
yeah,
believe I might be wrong about this, but I think one of the biggest early subscribers to Demark was Stevie Cohen.
yeah. No, I exactly. There are
Yeah.
legit people who
Yeah,
who
so
do it.
it says enough.
And on does Prometheus subscribers tell us the research that they get other than the portfolios, or are they literally just paying for the portfolios because all the other research is free?
You are just paying for the portfolios. If we find something super interesting mechanically, so we're always kind of doing strategy development, right? Like we're always trying to create new strategies, new signals, all that type of stuff. Every now and again, we might find something mechanically super interesting that we think is tradable. And so, we might share that. So a recent good example was what we've been noticing since 2023 is a very, very strong persistence of bond mean reversion. And so what we did was we basically went through the mechanics of what's driving bond mean reversion and why we thought that that's going to continue. That type of thing is, has a very tangible monetary value if you know what you're looking at. And so we would, that type of thing would typically be paid. But everything other than the portfolios, by and large, if it's simple, fundamental macroeconomic research, will be free. The more complex, tangible, you can trade the stuff, will be behind a paywall.
Yeah, definitely. If you're not interested in ETF stuff, definitely sign up for Prometheus Macro Research. That's free. Yeah, I mean that's a big bold call that people shouldn't pay for forecast or research. They should just pay for portfolios. But hey, more power to you. And definitely, if people are interested in those three model portfolios, they can get a 20% discount using the link in the description, and that will end in early December. All right, Ahan, let me just throw a few asset classes at you right now. You said you're relative to your positioning this year. You've pulled back on stocks and commodities
Mhm.
a little bit. Just give us a little bit more color on that. I mean, you said okay that this even though GDP forecasts are still very strong, or GDP nowcasts are still very strong, you have concerns and your models have concerns about the sustainability of AI capex. But what specifically are your models picking up that is giving it the hesitation and pulling back on the risk allocation?
So I think there are a few things. So there's the index level view. So we've already talked about the index level view, right? But we have the good fortune of, in the multi-strategy program, basically be going asset by asset, and that extends to both sectors and global equity indexes, right? And so what we're seeing there is that aside from tech, earnings momentum in most sectors is not very good. You see that, and when you kind of expand that horizon and look across kind of global equity indexes, you see a similar picture kind of emerging. What's also begun to happen at the global level is a lot of local FX equities have begun to underperform in their trends. And so basically, we've talked about the divergence and the mispricing and all of that stuff. But what we're also getting is we're getting corroboration across a broad array of different assets. So if you look at, US equity sectors today, things like energy, industrials, sectors that are more cyclically oriented, things like home builders, all of these places are not, one, seeing good macro fundamentals. Two, they don't have good earnings expectations growth. Three, like relative to, other assets, their trends have begun to deteriorate quite meaningfully. And so as trend breadth kind of begins to deteriorate across the complex, you basically want to start pulling back on your exposure a little bit. Now, that doesn't mean that there's nothing to be done, right? There's always something to be done. I
There's
think
always a
the
bull market somewhere, Jim Cramer,
Yeah, there's always a bull market somewhere.
He's
Absolutely.
right.
And so I think the in the US, the interesting exposures that we've been looking at are to basically be short things that are more cyclical. So, be short things that are like energy, and to be long things that are more kind of stable, or, perhaps, something like utilities or healthcare. Those relative value plays have been really interesting. Globally, I think one of the really interesting expressions that we've had is actually to be long the UK while being short European countries, because in the UK you have basically still managed to get the uptick in global beta, but at the same time, the UK indexes are not as tech dominated. And so as a result, you have much, much deeper value over there. And you also tend to have higher earnings yields. So you get a combination of like better value, a little bit better growth relative to the rest of Europe. And so those expressions have generally been quite interesting. So I think the takeaway from our equity strategies is really that you want to be running, if you have the capability to do such things, of course, like you want to be running closer to long short exposure than you want to be taking big swings on beta right now. We just don't think that beta, even if it goes up, right? Beta, even if it goes up, is not a very, very good risk adjusted return from here. We think that there's more value to be done in kind of dispersion trades than there is to be in outright beta bets.
And you said, Ahan, that you've got some serious concerns about cyclical parts of the economy, housing, manufacturing. Why is that making you less constructive, less bullish now? Because that's been true for 3 years. Housing weak, manufacturing weak. What's different now?
I think it's just the extent to which the divergence has started to occur. And so, I mean, part of it is like we have a lot of dependence on what asset prices are telling us, right? So like we do take a lot of signals from what's happening to local trends in all of these assets. But I think the major thing that makes me as an individual much more concerned is also the fact that essentially when you start to look at the dispersion in earnings now, by our measures, earnings expectations are growing at, somewhere between 10 and 12%. Almost all of that is coming just from tech. And so those divergences are starting to become really large. And now you're getting that alongside. So earlier it was a situation of, okay, the rest of the economy is sluggish and tech is very good. Now it's a situation of tech is very good and the rest of the economy might be going into contraction. And that's not always usually a very sustainable dynamic, particularly because the employment is not distributed the same way as the profits. And as we talked about, like at the top of the conversation, what you really need is you need the employment to be somewhat stable, at least for economic growth to continue. And so, yeah, I think that's what really makes me more concerned. And you see that mirrored not just in the US, you see that dynamic not just in the US, you see it across the globe. Like tech is basically eating everything across the planet. And so if you look at earnings expectations for, the US relative to, we do a 10 country equal weighted average of, earnings for the rest of the world. Rest of the world earnings are terrible. Earnings growth is terrible compared to the US. And so, is that a sustainable dynamic where the US, particularly this tech slice, dominates earnings and earnings growth indefinitely? Like we just don't think so. So something to be a little bit more concerned about, particularly with the fact that we started to see all of these trends in cyclical parts of the US economy in terms of equities, and then also looking globally at global equity prices, we started to see meaningful deterioration in those price trends as well. We want to get a little bit more cautious.
So overall, the rest of the world earnings growing so much smaller than US earnings, that you said that can't continue indefinitely. Of course I agree with you that that can't continue indefinitely. But what isn't that but what about for another year, Ahan? To throw it back at you, isn't that kind of a long-term forecast? And isn't the value of long-term forecast not that high? For
Yeah.
you to make short-term changes to your model portfolios, I think it would have to be higher than that. So is it really what's driving the bearishness or the lack of bullishness, Ahan? Is it really the negative trend and the negative breadth of the trend? Is that what's driving it?
I think the way you frame that is you were saying that okay, we're looking at the breadth and then short S&P, long S&P. And what I'm saying to you is we're trading each and every one of those individual assets. And so if the trend in any one of those assets is down and the earnings in that asset is down, we're going to be getting closer to neutral or possibly even short those assets. And so what we end up is like we're trading the French equities, we're trading the European equities, we're trading the UK equities. And so when we're looking across all of those individual equities, the aggregate size is coming down because the S&P 500 is one line item amongst all of them. And so, yeah, do we think the earnings are strong and probably stay strong? Yes, but when you start looking at the fact that the S&P 500 is so grossly overvalued relative to everything else in the world, and also the fact that you've basically started to have a broad-based decline in momentum, your aggregate exposure across the entire basket starts to get smaller. And I think that matters much more than saying that, oh, take the view across the 10 assets and then apply that to the S&P 500. No, I wouldn't do that. What I would do is I would say have the individual view for each asset and then see what that nets out to. And when we take those individual views across sectors and across the global equity market, that basically tells us that hey, like we want to be playing for long short differentials and kind of minimizing our beta exposure. Does
And
that
so
make sense?
it does for the multi-strategy, but in the S&P model portfolio and the ETF portfolio, is it similar, or yeah, just constrained to those assets? What is it?
So in our S&P and our ETF portfolios, we've been long equities, but much more conservative. So like unlike, the multi-strategy program, which can change its mind every single day, what we've basically had is a slow reduction. So I think our S&P 500 program as of yesterday has like a 30% allocation to the S&P 500, but we've increased our fixed income allocations and we've increased our gold allocation, we've increased our tips allocation. And so as a result, like what you've had in those programs is you have a slow kind of downtrend in exposure as opposed to the multi-strategy program, which can go long and short many different things. And those two programs are supposed to be different in the way they approach markets because for an individual investor to basically like whipsaw every single day, you just get completely crushed by transaction costs, frictions, and all of that. And we just don't want that. So the S&P and the ETF programs, they still have long exposure, but they're going to be more and more conservative. And we're starting to dial up fixed income exposure. As you know, Prometheus hasn't been long fixed income since Liberation Day. And so that's another sign of, hey, like growth is a little bit more concerning. We're starting to get a little bit more long there. So yeah, that's kind of the difference between those programs.
What about commodities, and in particular gold and
Mhm.
also oil and energy?
Gold, I mean, I think gold is like an interesting strategic allocation to have. When it comes to, recently, like you just had this crazy kind of blow off top in gold or whatever. And like we were lucky enough that all of our strategies are basically like denominated in expected return divided by risk, right? And gold vol just exploded to the moon. Like it just went absolutely crazy. And this was on the way up, by the way. This wasn't like on the way down only. This was on the way up. And so as gold vol just exploded, our strategy said that hey, like this might not be the best thing to own. We also have, I think last time we shared with you, how gold is basically driven by particularly today is driven by the amount of tonnage that goes into the ETFs. Like the marginal flow into gold is basically ETF flow now. And
But what about non-Western investors like Indian and Chinese investors?
yeah, I mean there is definitely that, but the main thing I think that has moved a lot that explains a lot of the price change in gold recently is actually the ETF flow. And a lot of that ETF flow, like it comes from other countries or whatever. So it's the tonnage that basically results from the ETF flow. And so, what we had seen is basically like the prices had just dramatically kind of overshot those tonnage metrics. And so, it opens up a kind of window of vulnerability, right? Between the explosion in vol, the explosion in price relative to the underlying tonnage. And so we just, our strategy is basically like reduced exposure a lot. Now, vol has chilled out a little bit. You've had a bit of a sell off. we started to add. So our S&P 500 program, I think, has like a 5% allocation to gold. It's like a starter position. Our multi-strategy has a little bit bigger of a position because it's a little bit more unconstrained in terms of its ability to turn over. So I think gold looks decent, but I think that it's going to be a rocky time with this amount of vol. Like gold is interestingly a lot more like an equity when it comes to its volatility characteristics than it is another commodity. So
Meaning
most
what?
commodity,
Yeah.
so most commodities, right? Like they crash up, right? So what that means is like the vol explodes and they start going up. Gold is not like that. Gold has a very nice property of, vol is a very good indicator of whether gold is going to have positive expected return or not. And so, we begun to, we have a position. We think gold is good. It's still like a little bit ahead of those tonnage and macro fair value estimates that we have. So you don't want to add too much. When it comes to industrials, honestly, we could go either way because the industrial, I've been describing, like the industrial complex is not like a very good place, but all of the weird tariff geopolitical stuff is just like causing industrial commodities whipsaw all over the place. So the second you have some sort of tariff thing related to industrial commodities, the trend just explodes. And so, I think fundamentally when you actually look at the economic dynamic, you're basically in a neutral to negative period for the industrial economy, and that results in okay, like flat fundamental demand for industrial metals. So that could kind of go either way for us. No big convictions there. When it comes to energy, I think we're pretty bearish on crude, mostly because when you look at energy is almost entirely an inventory game, right? Like what the marginal price of energy is basically set based off the inventory cycle. And so what you're trying to do is you're basically trying to say, hey, can I predict inventory is better, or can I position in line with the inventory cycle better for a given amount of demand? Now, what you're seeing is, and how does that, how do those inventory cycles evolve? It's basically based off whether global producers are actually drilling a lot of oil or not drilling a lot of oil. They basically, and so how that works is, global oil producers need to be profitable, and how they become profitable is basically if nominal GDP accelerates relative to a given trend. So like the rate of change of GDP actually does matter when it comes to oil. And so what you have today is you have a slowdown in the pace of nominal GDP, which has been a meaningful weight on global oil producers. And so their profits kind of are terrible, and they aren't engaging in much drilling activity. So there's not actually much happening on the inventory side over there. Inventories are basically neutral over the last year for crude. Now, the thing that's particularly relevant in today's context is because of tensions in Russia and in the Middle East, you have a huge amount of shipping delays from production to inventories. So you have just like a tremendous amount of supply of oil that just hasn't hit inventories yet, like to the extent that it's like higher than COVID.
Floating. Wow.
Yeah, yeah, it's
Wow.
it, it's
Really?
crazy. And so all of that eventually makes its way to inventories, which will show up in the Department of Energy prints at some point, and that'll be a big negative for crude. And so we'll try to press that when it starts to show up in the price data and when it starts to show up in the inventory data. But I think that that's the big overall picture. But right now we're a bit negative. We're negative on crude. We have some spread trades in gas oil and such, but those aren't like big thematic calls or anything like that. I think the big thing is that you will have energy down. So that's the commodity complex. Overall, the commodity complex is not a super inflationary backdrop, right? Like you think about all of this happening there, and then and so yeah, like the overall is like neutral to in some cases pretty negative for commodities.
Okay. Any other asset classes that your models have a interesting view on?
Bonds. Yeah, not US bonds. I don't know how many people are going to want to listen to this particular segment, but the thing where we actually been had the maximum risk is actually trading French or European bonds relative to JGBs because
Japanese government bonds. Yep.
yeah, and the reason is basically, when you're buying a bond, as we've talked about many times, I'm sure at this point, you're trying to get the maximum amount of carry for the least amount of macroeconomic volatility. Now, or another way of saying it is like you want to get the maximum amount of carry for the least amount of growth, right? That's the way you buy a bond. In We're getting a pretty significant amount of dispersion in terms of growth conditions between Japan and the EU, because Japan is basically, going through a situation of the hardest macroeconomic conditions it's had in like 5 decades or whatever, whereas the EU is going through this structural difficulty. And when we look at those bonds, the French bonds stand out to us as particular.
Because you're quite 4 decades, 4 decades.
Sure. 4 decades. I appreciate the check, man. But and so, when we look at those differentials, you basically start to see, a very nice opportunity to get long French bonds relative to JGBs, where the JGB market has been under immense amounts of pressure, whereas the French bonds have, relative to the JGBs, shown a significant amount of outperformance. So, like when I look at our global bond composites, like the much, my directional view on treasuries, which is reflected in our programs, which is kind of like not super interesting. It's more range bound. The opportunities in global fixed income are really in this particular segment, and we've been running like quite a significant amount of the our aggregate risk in this particular trade over the last month, and it's shown quite a bit of momentum. And yeah, like it essentially boils down to a bet on EU growth not very good, Japan growth kind of okay. You actually see that also in the equity differentials. So if you look at the Nikkei versus the CAC, or the Nikkei versus the DAX, but the thing is that the pricing isn't as favorable on the equity slice. Basically, Japanese equities are valued pretty highly, much like the US counterparts. So we really like to express this kind of in the bond segment.
That makes sense. Ahan, the only other thing we haven't covered is housing. You write
Mhm.
about how housing is very weak. Is anything new here? Because hasn't housing been weak for 3 years? Or is there something new that is an additional layer of concern?
I don't think there's anything new. I think it's just getting worse. I
That's
think
new. That's new.
I mean, it's a trend down, and you started to have even construction, the residential employment has begun to kind of fall off.
Fuck.
And I think that it's just, there's only so long that we can continue to have permit starts, completions continue to kind of fall off. It's resulting in pretty bad, kind of a pretty bad dynamic for the home builder equities. So that's another place where we're actually fundamentally pretty negative. And so, yeah, I think it's just like a continuation of a bad trend. And at some point, that starts to become like meaningfully impactful for the rest of the economy. Because if you continue to have really bad housing dynamics, it's going to it is resulting in lower demand for houses. It's resulting in a tougher time for the builders. They're going to have to reduce their prices. That's going to flow through to inflation calculations. And so, when you have those inflation calculations starting to come down, it's going to have meaningful impacts of whether the Fed can actually ease or not. And so I think one of the things that, yes, the continuation of the trend in housing is not super new, but it's worsening, which, I think is a modest is a more negative environment. And then on top of that, that's going to flow through to CPI, which basically means that it's going to be easier for us to get to target now with these housing dynamics than it was previously.
And that could be bullish, which enables the Federal Reserve to cut, although they may have cut anyway. But
Yeah,
yeah.
exactly. But that's the thing, right? Like, I think the tough thing so what is the best performing bond strategy of the year, right? The best performing bond strategy of the year is fade the cuts both ways. Fade the cuts, or fade. Yeah, so like if markets begin to price a lot of cuts, fade that. If markets begin to price less cuts, fade that. Basically,
Mean reversion kind of, mean reversion.
mean
Fade.
reversion is the best trade that has. And the reason is because the Fed has been stuck between a rock and a hard place. Like, you have all this employment data starting to look not very good, right? And that's an important part of their mandate. But at the same time, you have inflation. What, it's been 60 months, I don't know, somebody keeps a count of the number of months that they haven't hit target, but it's been like, 5 years of not a target. Now you start when you start to get to a situation where, okay, housing is really bad, that's going to weigh on CPI. Okay, like maybe bond mean reversion won't do as well anymore, and you can actually start writing bond trends which are consistent with an easing cycle. So these are the things that, we're sort of thinking about. I think that as we progress, we're starting to get to a more interesting place for bonds.
And I think a key point of this conversation, Ahan, that is really relevant is what matters to markets and asset prices and what doesn't. So, obviously, in 2007 and 8 and 9, housing was extremely relevant to the economy. Now it's way less weaker than it was in 2007 and 8, and for way less worrisome reasons, like way less. And mostly, the real issue I see from a societal point is that houses are too expensive, not that they're too
Mhm.
cheap and that there's a bubble imploding. But in terms of being able to track the S&P or just the broader economy, it really isn't that impactful. And I also think that, Ahan, there's such this macroeconomic commentary that I've been a part of just how the economy for so many people in the United States is has not been good in terms of the labor market is not been strong. The labor market's been weakening, and prices, even though inflation has gone down, prices are still high, and a lot of prices are going up higher than people's wages, even though in aggregate they might be going up. People's the aggregate wage might be going up slightly higher than the aggregate CPI. Like that doesn't really matter to real people, and that's totally true, and that's very valid commentary. That's very important to society and human beings, but it hasn't mattered to the markets. It just really hasn't. And I'd say it might, that type of commentary, if you implement it, might even have a negative Sharpe ratio. And so you're in the business of positive Sharpe ratios and having good risk adjusted returns. If not the actually getting them, then always pursuing them in an intellectually honest and rigorous and quantitative way. And so I think that there a lot of people watching Monetary Matters have very different goals. So if they're there for the commentary and the analysis and just finding stuff interesting, stuff to say at a cocktail party or stuff to say to clients, whether they're financial clients or otherwise. I think a fair percentage of people like listen to the show. Some percentage of people listen to this show so they can have sort of things to
Mhm.
say to their clients. Like, and I'm sure that's true of my competitors as well. Then, that's totally fine. But like, if you're trying to increase your risk adjusted returns and you're looking for someone who's intellectually honest and rigorous to do that, Ahan is your guy. And that is why we're partnering with him, and we've partnered with him in the past. So there's a 20% discount on an annual subscription. So I just did the math. So the full price that you would pay for that 20% discount from your regular annual pricing would be something like a 36% from if you were just paying monthly. But obviously, if you want to check it out, you can just try monthly. And also, even if people don't want to pay a cent on this, they can't afford it or something like that, they get sign up for Alhan's free research. So you can get all of the data and the analysis, not the portfolios. But if you want the portfolios, obviously people have to pay for that, and they can get a 20% discount. That discount ends in early December. So if you're watching this on like December 4th, if you don't want to buy it, don't buy it. But if you want the discount, like you probably should act pretty quickly.
Yeah, I think you covered it all.
There we go. Nothing to add. The Charlie Munger line. Ahan, thanks so much for joining, and please everyone leave a rating and review. Thanks for watching.
Take care, Jack.